If you're currently tracking the economy, you know the vibe out there is less than sunny. Every market headline seems to scream uncertainty, and the R word recession, it's popping up everywhere. But here's what's fascinating. While all this volatility grips the market, there's this small, sort of elite group of companies that consistently maintains growth, even when everything else seems to be cracking. So our deep dive today is all about durability. We're going to extract the essential knowledge from sources detailing 7 specific fortress stocks. These are companies designed not just to survive a slowdown, but maybe even gain market share. And crucially, we're also going to define the strategic rules you need to, integrate them effectively.
And that mission extracting the mechanism of durability, that's really key. We aren't looking for companies that are totally immune to market downturns. I mean, that doesn't exist. We're looking for businesses built on fundamental needs, so their demand is, inelastic. This resilience, it relies on essential products, essential services, and a consumer base that just cannot or will not cut back.
Okay, let's unpack this. So our first pillar is all about those basic human needs, specifically essential consumer staples and value retail. These are companies that don't just survive when wallets tighten. They're actually structured to benefit from it, that famous trade-down effect.
Exactly. And that strategic advantage brings us right to our first fortress stock, Walmart, ticker WMT.
It makes sense. When economic stress hits, consumers get, well, incredibly disciplined about where their money goes. Walmart's whole brand promise is everyday low prices. It becomes the automatic destination. But the real moat here isn't just low prices, right? It's their scale.
Yeah.
Especially that massive grocery business, which is non-discretionary. It anchors everything.
The insight here is really operational. I mean, Walmart has built this logistics and supply chain machine that very few companies can even hope to replicate. This scale, this massive scale, allows them to just instantly weaponize price cuts during a downturn. They don't just capture people trading down from, say, a premium grocery store. They can use that efficiency to aggressively gain market share while their smaller competitors are just struggling to hold onto their margins. That defensive strength is what matters.
Okay, so if Walmart is winning by offering the lowest price at the checkout, our second fortress, Costco, wins by proving this irresistible value through a subscription model.
It is a structurally brilliant model for stability. The entire business is built on that membership program. It provides this steady, high-margin, and highly predictable stream of revenue.
And the renewal rates are insane.
Oh, consistently above 90%. Think about that membership fee revenue. It accounts for a huge chunk of Costco's total operating income. It's revenue they can bank on, no matter what the stock market is doing.
And that stable income lets them pass on incredible value, which is exactly what you chase in a recession. The bulk buying, it just encourages you to stretch your dollar further on all the necessities, groceries, household item. They get customers to pay up front for the privilege of saving money later. That's a pitch that really resonates when money is tight.
Absolutely. It's that stickiness of the membership combined with the value proposition that creates this powerful protective barrier.
Okay, so moving from the big box retailers to the actual items in the cart, we hit stock number 3, Procter & Gamble, PG. This is the undisputed titan of consumer staples. We're talking about brands that basically run global hygiene. Tide, Pampers, Crest.
And what's fascinating here is not just that they sell necessities, but their unrivaled pricing power. You might cut back on a new car or a fancy dinner, but you are not skipping toothpaste. You're not skipping laundry detergent.
Never.
That unwavering consistency gives P&G extremely stable revenues.
And the advantage goes beyond just strong brands. It's about total market dominance. I mean, P&G has such efficient global distribution and these powerful relationships with retailers that they just command the shelf space. That dominance is a structural moat. It limits competition and lets them pass along price increases, even during high inflation, without losing a lot of volume.
Their history proves it. The source material highlights P&G as a dividend king.
Right, 50-plus years of dividend increases.
Yeah, exactly, 50 or more consecutive years. That isn't just capital discipline. It is tangible proof that their business model selling small, essential things at high volume is just cycle agnostic. It's durable.
Okay, so that really covers the essential goods pillar. So if pillar 1 was about non-discretionary products, pillar 2 moves into non-discretionary services. We're talking about the true non-negotiables: healthcare, utilities, and, basic connectivity. Let's start with stock number 4, Johnson & Johnson, J&J. The ultimate powerhouse in healthcare, which is pretty much the most defensive sector of all.
J&J offers stability through just massive diversification. Even after its recent spinoff, the core business is still huge in pharmaceuticals and medical devices.
Yeah.
And critically, healthcare demand is largely recession-proof.
Hmm.
Whether it's a life-saving medication or a necessary surgery, that demand is stable, it's predictable, and it's often funded by large government programs or insurance. That insulates it from consumer anxiety.
The sources really focus on their dividend history over 60 consecutive years of increases. When you see numbers like that, you know the management team is confident. They know their cash flow is durable, no matter what the forecasts say. It's just a magnet for capital looking for safety and income.
Yeah, and unlike some pharma companies that might rely on a single blockbuster drug, J&J's pipeline is so broad. You couple that with their dominance in complex medical devices, and it just limits their dependence on any single product. It really solidifies that fortress status.
Next up is stock number 5, Next Era Energy, or NE. Utilities are, traditionally kind of boring and defensive, but NextEra has this really fascinating hybrid model stability with a big growth engine.
Utilities are classic recession-proof plays because electricity demand does not drop when the economy slows. People still need to power their homes, their hospitals. So NextEra gives you that defensive stability from its regulated utility in Florida, Florida Power and Light, a massive, reliable cash generator.
But the growth angle is the real differentiator here. They've just aggressively invested in their NextEra Energy Resources division, focusing on clean energy, solar, wind, storage. And this isn't just speculation. This translates into highly predictable long-term cash flows.
Exactly. The growth comes from long-term contracts. They're called power purchase agreements, or PPAs.
Right.
These are like 15 to 25-year contracts to sell the power from their renewable assets at a set price. This contractual income just minimizes risk, commodity risk, macroeconomic risk. It creates this powerful growth mechanism, all while being underpinned by that stable utility cash flow.
Okay, moving to another fundamental necessity. Let's talk about stock number 7, Verizon. VZ, built entirely on essential recurring revenue, connectivity.
Yeah, think about it. When a recession hits, what services do you actually cut? You might cancel a streaming service, maybe two, but your wireless phone and your home internet, they've shifted from being a luxury to an absolute necessity.
The stability factor here is almost unparalleled. Customers pay monthly and they pay reliably. I mean, even during the 2008 financial crisis, the dip in wireless demand was tiny. This just generates incredibly stable, high-quality cash flow for Verizon.
And that stability is reinforced by the massive barrier to entry in telecom. You need billions in capital for infrastructure, for spectrum, for regulatory hurdles.
Right. You can't just start a competitor in your garage.
Not at all. And this high bar limits competition, lets Verizon maintain its pricing power, and, crucially, lets it offer one of the higher dividend yields among large-cap companies. It is, as the sources put it, steady, predictable, and boring in all the best ways.
Which is exactly what you want for a defensive income play. So we've covered the core necessities. But people don't just consume staples and pay bills. They still need those small moments of comfort, even when spending shrinks. And that leads us to pillar 3, the affordable comfort zone.
And this brings us to stock number 6, McDonald's, MCD. A titan in the fast food industry, and historically, one of the strongest recession performers in all of dining.
And the mechanism is that same trade-down effect, just applied to leisure. People still want to go out, they still want to avoid cooking, but they trade down from mid-tier restaurants to something super affordable and convenient, like McDonald's.
And the underlying structural advantage isn't really selling burgers, it's the franchise model. McDonald's is mostly an asset-light operator. It generates steady royalty payments and rents from its franchisees all over the world.
Oh, that's a good point.
And that protects their margins during inflation and slowdowns much better than a company that owns all its own locations.
Plus, they've perfected the efficiency mode. The drive-through, the digital ordering, that ubiquitous brand recognition. All of that makes it the familiar, convenient, and affordable default option when every other expense is under scrutiny. Okay, so we've identified 7 companies built on these incredibly durable models. But holding a fortress stock means nothing if you position it wrong. These have to be part of a balanced plan, not the whole plan. So what are the 4 core strategic rules for integrating them successfully?
This is where we move from theory to action. The first rule is position sizing. Defensive names are not designed to outperform the NASDAQ in a bull run.
Yeah.
They're designed to stabilize returns. They act as ballast when the market rolls over. So depending on your age, your risk tolerance, they should typically represent maybe 5 to 20% of your overall portfolio. The goal is risk mitigation, not maximum return.
Okay, rule number 2 is dollar cost averaging. This seems critical because even recession-proof stocks fall during a huge market panic. When fear spikes, everything gets sold off. Averaging in helps you reduce that timing risk so you aren't trying to catch the absolute bottom. The key insight here is separating the start price, which is just sentiment, from the business fundamentals.
Precisely. The third rule is often overlooked, but it's vital. Watch debt levels. When interest rates rise, even a stable business can face pressure if it's over-leveraged.
Okay, so what should you look for?
For a company like this, you need to monitor metrics like the interest coverage ratio and debt to EBITDA. You want to see high cash flow against manageable debt. For a utility like NextEra, sure, a certain amount of debt is normal, but for a consumer staple like P&G, you want to see very high coverage to protect those dividends.
That moves us neatly to our final rule, which ties right back to the dividend kings we talked about. Focus on dividend sustainability, not just the yield. A high yield can often be a warning sign.
It can be. What matters is the track record and the payout ratio. A long, strong dividend history, like those 50 or 60-year records from P&G and J&J, is the most reliable signal of a truly durable business model. And, more importantly, check the payout ratio. How much of their earnings are they paying out? If it's 80 or 90%, that dividend is fragile. A stable fortress stock pays out a manageable portion. That leaves room for growth and maneuvering during a crisis.
So to recap, we've covered all these defensive archetypes. We looked at value retail with Walmart and Costco, pure consumer staples with P&G, the non-negotiables of healthcare with Johnson & Johnson, the growth hybrid utility NextEra, the affordable comfort of McDonald's, and reliable telecom income with Verizon. These are businesses that thrive not on hype, but on the enduring strength of human need.
And this raises the final important question for you to consider as you structure your own defensive sleeve. How do you balance the need for immediate dependable income, which you get from high-yield, high-stability names like Verizon or J&J, versus the potential for long-term growth and market share gains, which you might see in a name like Walmart